Welcome to the Explainer. Today, we're going to crack the code. You know those squiggly lines on stock charts that everyone talks about? By the time we're done here, you'll have the keys to turn all that noise into some really clear, actionable ideas.
You know that feeling, right? You pull up a stock chart and it's just a mess, a total jumble. But what if I told you that every one of those peaks and valleys, it's not random? It's all part of a bigger story, a story you can actually learn to read.
And to read that story, well, you're going to need the right tools. So today, we're going to build out your very own technical analysis toolbox, filling it with the essentials, one by one. Let's get right to it.
All right, let's dive in. First things first, we've got to stock this toolbox with the absolute core indicators. These are the things traders are looking at every single day to figure out a stock's health and, its momentum.
First up is the RSI, which stands for Relative Strength Index. Honestly, the best way to think about it is like a speedometer for a stock. It measures how fast the price is moving, and it does it on a super simple scale from 0 to 100.
And what's great about the RSI is how clear its signals are. If you see a number pop up above 70, that's a sign the stock is overbought. Think of it like a car engine that's getting way too hot and probably needs to cool down. On the flip side, if it drops below 30, it's oversold. It might be running out of gas on the way down. Now, a lot of traders keep an eye out for that sweet spot, when the RSI starts climbing up from that 30 to 40 zone, especially if the stock's already in an uptrend.
Okay, next in the toolbox is the MACD. Now, I know, the name sounds super complicated. Moving average convergence, divergence. But its job is actually pretty simple. It's all about confirming the trend's direction and momentum. And here's why that's so useful. Because it's built on older price data, it's a little slower to react. That might sound bad, but it actually makes it an amazing confirmation tool. It helps you from, jumping the gun on a signal that turns out to be fake.
So, the key thing to watch for here is the crossover. It's that simple. When the faster MACD line crosses above the slower signal line, that's a bullish sign. It's the hint that momentum might be shifting up, and you guessed it, when it crosses below, that's bearish. The real pro move, don't just act on this alone. Use it to confirm what your other, faster tools are already telling you.
All right, so we've got our momentum tools packed. Now let's zoom out a little. It's time to talk about the big picture stuff, the foundational indicators that help you figure out the market's overall direction. We're talking about the trend itself.
Simple moving averages, or SMAs for short, are pretty much the bedrock of trend analysis. What they do is they smooth out all that crazy day-to-day price noise, giving you a much cleaner, clearer view of what's really going on. And the two that everyone, and I mean everyone, watches are the 50-day and the 200-day.
And this really breaks down the two main flavors of moving averages perfectly. Think of the SMA as the slow and steady lane on the highway. It's great for the big, long-term picture. But the EMA, that's the fast lane. It pays more attention to what's happening right now, which makes it super responsive and perfect for traders who are looking at shorter time frames.
Okay, now listen up. Because when these two big moving averages cross paths, the whole market sits up and pays attention. It's a big deal. When that shorter-term 50-day average moves up and punches above the long-term 200-day, that's called a golden cross. It's a seriously powerful bullish signal, and it often means a big, long-term uptrend could be started.
And then there's the death cross. And yeah, the name says it all. It's the total opposite, and it's pretty ominous. This is when the 50-day crosses below the 200-day. That is a major bearish red flag that the long-term trend might be heading south. It's a huge sign to, be careful.
Okay, let's switch gears and talk about volatility. Your go-to tool for this? Bollinger Bands. What they do is create this channel, kind of like a river, around a stock's price. When that river's wide, things are wild and volatile. When it gets narrow and tight, the market is quiet, maybe a little too quiet.
So if the price touches that upper band, the stock might be getting ahead of itself. If it hits the lower band, it could be oversold. But the real magic, the thing everyone waits for, is the squeeze. That's when those bands get super tight. Think of it like a coiled spring, just building up all this energy, getting ready for what's often a huge, explosive move. You just don't know which way it's going to break.
All right, we've got our tools. Now for the fun part, learning how to use them together. Because here's the secret. Nobody uses just one of these in isolation. It's like having a team. Their real power comes out when you combine them, when you get them working together as part of a single strategy.
And your strategy? It really all boils down to your time frame. Are you a swing trader trying to catch moves over a few days or weeks? Then you're going to need those faster tools like the EMA and the MACD. But if you're a long-term investor, you're looking at the big picture. You'll be leaning on the heavyweights, like that 200-day SMA, to tell you what the major trend is.
And check this out. This is a perfect example of a checklist for a potential trade. See, it's not about finding one perfect signal. It's about building a case, like a detective. You're looking for clues. And when multiple separate indicators all start pointing in the same direction, that's called confluence. And confluence, my friends, is what gives you a really solid high-probability setup.
Okay, now for a quick reality check. This is probably the most important thing you'll hear today. These indicators, they are not crystal balls. They can't predict the future. They are tools for understanding probability. They help you stack the odds in your favor, but they never, ever give you certainty.
Which brings us to a key risk management tool, the ATR, or Average True Range. This one's really unique because it doesn't care about which way the price is going. Its one and only job is to measure volatility. That's it. It just tells you, hey, on an average day, this stock tends to move about this much.
So how is that useful? Well, a really common way to use it is for setting your stop loss. You know, your get-me-out-of-here point if a trade goes bad. A lot of traders will set their stop loss maybe 1.5 times the ATR value below where they got in. Why? Because that gives the trade enough breathing room to jiggle around naturally, without getting stopped out too early, but it still protects you from a massive loss.
And for those of you who want to get a little more advanced, you can actually automate this whole thing. Like the source material for this explainer even shows how with some pretty simple Python scripts, you can tell a computer to scan the entire market, looking for stocks that match your perfect setup. It can check hundreds of charts in just seconds.
So, let's wrap this all up. What's the big takeaway? Remember, indicators are about reading probabilities, not predicting the future. They work best as a team, so combine them to build a stronger case. And always match your tools to your time frame. At the end of the day, it's all about making smarter, more informed decisions, not perfect ones.
And that's our explainer for today. You now have a solid toolbox to go out there and start decoding that secret language of the market. The charts are waiting, so the only question left is, what stories are you going to find? Thanks for joining us.